Okay, so for this session, we'll be having intangible assets, which is covered by IAS 38 with the same title, Intangible Assets. So for our topics, these are the items that we will be discussing. We have objective and scope, definitions, recognition and measurement, recognition as an expense of intangible assets, measurement after recognition. We have the concepts of useful life. We have also a separate discussion of intangible assets with finite useful lives and intangible assets with indefinite useful lives. In addition, we will also be discussing the recoverability of the carrying amount in relation to our impairment losses. We also have retirements and disposals as well as disclosure. So these are the subtopics or the topics that we will be having for this particular topic. So to start with, let us immediately start with the objective and the scope. So when you talk about the objective and the scope of the standard, which is basically IAS 38 intangible assets, so the main goal is basically to account for intangible assets, to prescribe the accounting treatment for various intangible assets, which is covered by the standard. Because take note, not all intangible assets are covered by IAS 38. Only those that were able to satisfy the requirements of the standard are treated as intangible assets under this particular standard. Which means that even if it is technically considered as intangible assets in a general business setup, it may not be considered as an intangible asset in the point of view of the standard. Okay, so we will elaborate on that later on. Okay, so the standard requires an entity to recognize an intangible asset if and only if specified criteria are met. So that's why we stated that we need to satisfy the criteria. The standard also specifies how to measure the carrying amount of intangible assets and requires specified disclosures about intangible assets. We will be dealing with that later on. So the standard will be applied for all account or for the accounting of all intangible assets except for those that are specifically covered by other standards, such as intangible assets that are within the scope of another standard, meaning if a specific standard is already covering that, then it is not covered already by IAS 38. That's actually very self-explanatory because the stand or the IASB does not want any discrepancies or problems with the um, with the various standards that are being applied to one particular item. So if it is already covered by a specific standard, then it is no longer covered by IAS 38. So examples will be your financial assets, which is defined by IAS 32. We have wasting assets because it is covered by IFRS 6. And we have expenditures on the development and extraction of minerals, oils, natural gases, and other non-regenerative resources because it is still covered by IFRS 6 later on. And also part of inventories when it comes to the accounting but not the measurement because they have different measurement criteria. Um, in addition, the standard does not apply to intangible assets which are considered as inventories, deferred tax assets because it is covered by IAS 12, leases of intangible assets accounted for in accordance with IFRS 16 because if it is already a leased asset, then it is going to be accounted for as a right of use asset on the point of view of the lessee. We have assets arising from employee benefits, which is covered by IAS 19. We have financial assets covered by IAS 32. We also have goodwill acquired in a business combination because it is covered by IFRS 3. Contracts within the scope of IFRS 17, insurance contracts. We have non-current intangible assets which are held for sale because it is covered by IAS 5 already. And assets arising from contracts with customers because it is covered by IFRS 15. So basically, all other assets or all other intangible assets will be covered aside from those specifically stated as excluded from the standard. So with that, let us proceed already with our definition. So the first item, because this is alphabetical, is the definition of amortization, which is basically the same as depreciation. Okay? But because this is talking about intangible asset, we cannot generally depreciate something that has no physical substance. So, we're going to use the term amortization, which is allocation of the depreciable amount of an intangible asset over the useful life. Okay? So, we also have the general definition of an asset, which is a resource controlled by an entity and from which economic benefits are expected to flow to the entity. So because intangible assets are assets as part of the general definition, it needs to satisfy the definition of an asset before it can be accounted for in the books as an asset. We also have carrying amount, which is the same as the carrying amount definition for property, plant, and equipment, and all other items that are using cost method, which is basically the amount of the asset recognized in the financial statement after recognizing any accumulated amortization and impairment losses. We also have the cost items or cost concept, which is basically the amount of cash or cash equivalent or the cash price value of a particular asset or fair value of a particular asset at the time of acquisition or construction, or depending on the method of acquisition of a particular asset. We have depreciable amount, which is basically the cost less any residual value. We have development, so the concept of development, which is basically the process of the application of research findings. So that's why when we go to research and development later on, basically the concept there is the application of the research findings or the knowledge that was obtained during the research phase of a particular venture or a particular research and development project. We have entity-specific value, which we already specified before as the same as value in use because it depends on how the entity expects to use a particular asset. We have fair value, which is again the fair value which is defined by IFRS 13. We have impairment loss, which is basically the amount by which the carrying amount of the asset exceeds the recoverable amount. We discussed this already when we were discussing IAS 36. We have intangible asset, which is an identifiable non-monetary asset without physical substance. So that's the general definition. We will discuss later on the specific requirements of the standard in order to recognize something as an asset. We have monetary assets, which are money held and assets to be received in fixed or determinable amounts of money. So monetary assets are not covered by the standard, but it is considered to be the considerations that are used to pay or to acquire a particular intangible asset. We have research, which is the original and planned investigation undertaken with the prospect of gaining new knowledge, whether scientific or technical. We have residual value, which is the same as the residual value in the concept of your property, plant, and equipment. So this is basically the remaining amount that will be obtained upon the disposal of a particular asset. In this case, the amount that will be obtained upon the sale of an intangible asset at the end of its life. So since we're talking about the useful life, so the useful life is pertaining to either the period over which the asset is expected to be available for use or the number of production or similar units expected to be obtained from the asset by the entity. So it's either based on time or based on the productive capacity. Okay, so with that, we can now proceed with the key features of a particular intangible asset which will be recognized under IAS 38. So according to the standard, 3 items should be present for an item to be considered as an intangible asset. First is identifiability, second is control, and third is economic benefits or future economic benefits. Of course, control and future economic benefits are a given already because these are features of a particular asset. So, intangible asset being an asset should satisfy the definition and the recognition criteria for all assets. And identifiability is now the concept that distinguishes intangible assets covered by IAS 38 and intangible assets not covered by IAS 38. So let us first discuss the concept of identifiability. So identifiability is something that will be met either through letter A or letter B. So an asset is identifiable if first it is separable, meaning it is capable of being a subject of a particular transaction, whether it is going to be sold, it is going to be leased, it's going to be transferred, it's going to be exchanged, rented out, etc. Or it arises from a contractual or other legal right, regardless of whether those rights are transferable or separable. Okay? So it's either it is separable, meaning it can be a subject of a transaction, or it arises from a contractual or legal right. Okay? So meaning it is identifiable for as long as we can separate it from other items, and this arises from contractual or legal rights as a result of past transactions. Control is basically a matter of determining who has the power to obtain the future economic benefits. So control does not necessarily mean ownership. So it does not necessarily mean that you need to be an owner for you to have control of the asset. Being a lessee can also result in control, or being an assignee can also result in a control. So basically the concept there is just to make sure that we are the one, or the entity is the one who will obtain the future economic benefits. And of course, since we're talking about future economic benefits, this is pertaining to any benefit that will be, or that can have a numerical, or that can have a financial value, which could be in the form of revenue from sale, cost savings, or other benefits resulting from the use of the asset. Next, so with all of those definitions and all of those criteria relating to intangible assets, so assuming all of those are already satisfied by a particular asset, then we can now recognize a particular asset. So for recognition and measurement, the standard specifically states that the recognition of an item as an intangible asset requires an entity to demonstrate that the items meet, or the asset that we are trying to recognize under IAS 38 are able to meet the definition of an intangible asset and be able to meet the recognition criteria. So the definition of an intangible asset is basically an asset that has, or a long-term asset that has no physical substance, and the recognition criteria is basically control and future economic benefits. So an intangible asset, again to emphasize, shall be recognized only if it is probable that expected future economic benefits will flow to the entity and the cost of the asset can be measured reliably. And an entity shall assess the probability of expected future economic benefits using reasonable and supportable assumptions that represent management's best estimate of the set of economic conditions that will exist over the useful life of the asset, so that we can determine the probability of the future economic benefits. And once we are able to determine this already, then we can have a basis of the cost, or as the initial recognition, or as the initial amount for that intangible asset. So basically, if the expected future cash flows are not probable, then we cannot recognize it as an intangible asset yet. We need to make sure that it is probable and that we are able to determine how much is the expected economic benefit. So let's proceed. So since we assuming that we are now able to determine, or we are now able to, or an item was already able to meet the recognition criteria, and since we know that for initial measurement we are going to recognize the intangible asset at cost, the thing that we need to understand is how are we able to achieve, or how are we able to obtain a particular intangible asset. So just like what I said before, when we were discussing property, plant, and equipment, the acquisition of an intangible asset is generally the same or similar to with that of a property, plant, and equipment, because the only difference here is that PPE has physical substance while intangible assets do not have physical substance. So these are the general means by which we can acquire intangible assets. First is separate acquisition. So separate acquisition pertains to purchase of intangible asset. So in the case of purchase, the purchase is always the cash price equivalent or the present value of the intangible asset, including any initial direct or directly attributable cost. Okay, so if you still remember the capitalizable cost in the case of property, plant, and equipment, we generally talk about the purchase price, we talk about the directly attributable cost, and we talk about the decommissioning cost. But of course, in this case, there is no such thing as decommissioning cost for intangible assets because we because decommissioning cost is not relevant in the case of intangible assets. There is no such thing as a cost for decommissioning or restoring a site where an intangible asset is present, because in the first place there is no physical substance for an intangible asset, and therefore there is no such thing as um decommissioning of an intangible asset, because basically there is no cost for that. You're not going to spend anything on the retirement of an intangible asset. Aside from that, it is possible for us to acquire as part of a business combination. So in this case, acquisition of an intangible asset under a business combination will generally talk about the fair value of the asset or of the intangible asset that was acquired in a business combination. So similar to what you learned in business combination in advanced financial accounting and reporting. So in this case, the fair value of the intangible asset that was acquired will be the substitute of the cost when it comes to the combined FS already. So that's just the concept there. You get the fair value, and that's already the substituted cost of that intangible asset in the consolidated FS. Next, we have acquisition by way of government grant. So it's the same as what we learned in IAS 20. What you need to do is to simply determine if there is or if the grant has a condition attached or there is no condition. Generally, you're just going to debit the intangible asset and you're going to credit as either income if there are no conditions, or as deferred income if there are conditions to be satisfied. Okay. Aside from that, there is also exchanges of assets. So it is possible for you to exchange intangible assets with another intangible asset or with other non-monetary assets. So in this case, we will follow the rule of exchanges. And of course, since we are talking about the rule of exchanges, we need to determine whether the exchange has commercial substance or no commercial substance. And whichever is applicable, we're going to simply follow the requirements of the standard, which is similar to what is stated in IAS 16 for property, plant, and equipment. For exchanges with commercial substance, we're going to get the fair value. So we're going to have the GRG rule. So the first G is fair value of asset given up plus cash paid minus cash received. If that is not available, then we go to the fair value of the non-cash asset, or the fair value of the asset exchange to us, or what we received, fair value received. And if it is not available again, then we're going to use the the book value of the asset that we're going to give up plus cash paid minus cash received. So, of course, since we're talking about exchanges, it is also possible to exchange or to receive an intangible asset in exchange for liability. So in the case of liability, we're going to use the IRI rule. So you're going to get the fair value of the liability issued and then fair value of the asset received, or the book value of the liability that we issued. So that's the hierarchy there. Of course, when it comes to equity, we need to remember the RII rule. R being the fair value of the asset that we received, and then the first I being the fair value of the equity that we issued, whichever is more clearly determinable of the first two items. And if it's not present, then we're going to use the par value of the equity instrument. So that's the basic rule there. And then finally, for internally generated intangible assets, this is where we discuss the concept of research and development already. So since we're talking about research and development, let us go first to the research phase. So the research phase, as discussed already in the definition, this is the search for new knowledge. Okay? So in this case, no intangible asset arising from research shall be recognized because upon incurrence of cost during the research phase, it is already going to be expensed outright. Okay? Examples of research activities, which are also the items that are usually shown or usually provided in examples for quizzes or for board examination items, are activities aimed at obtaining new knowledge, the search for, evaluation and final selection of applications of research findings, the search for alternatives, the formulation, design, and evaluation of certain possible alternatives. Okay, so these are the main items. So generally, it is always, the context clues are always search, formulation, finalizing, okay, selection, all of those things. But when it comes already to applying, okay, application of your research findings, it is now the development phase. Okay, so of course, we know that as what was discussed in your lower years, the development phase will generally be expensed until technical feasibility was already established by the entity. But of course, the standard provides additional requirements aside from technical feasibility because in fact, there are 6 requirements prior to capitalization of the succeeding development costs during the development phase. So the first item is of course technical feasibility. So when the entity has already established that there is a practical use for the item that is being developed, okay? In addition, the entity should also be able to demonstrate its intention to complete the intangible asset and use or sell it. In addition, the entity also needs to show its or provide proof of its ability to use or sell the intangible asset. So, letter B is the intention to complete. Letter C is the ability to use or sell. Letter D is to establish also how the intangible asset will generate probable economic benefit. So, basically, you need to prove that this is the practical use, this is how we are going to generate cash flows, these are the activities by which we can be able to benefit from that particular intangible asset, so on and so forth. Letter E, the entity should also provide evidence of the availability of adequate technical, financial, and other resources to complete the project and the ability to measure reliably the expenditures attributable to the intangible assets during its development. So basically, before we can capitalize the succeeding costs of the development phase, we must be able to satisfy items A until F of the standard. And upon satisfying letter A to letter F, then we can now capitalize the succeeding costs to an intangible asset. So what are examples of the development activities? We have design and construction of prototypes. We have design of tools, jigs, molds, and other items. Design and construction of pilot plant. Design, construction, and testing of the alternatives chosen. And so on and so forth. Okay? So, now that we are done with the development, the research and development cost, we are now going to focus on the cost of the internally generated intangible asset, which generally will come from or will result from your research and development activities. So, according to the standard, the cost of an internally generated intangible asset comprises all directly attributable costs necessary to create, produce, and prepare the asset to be capable of operating in the manner intended by management. Examples of directly attributable costs are cost of materials and services used or consumed in generating the intangible asset, and cost of employee benefits arising from the generation of the intangible asset. Also, we have fees and fees to register a legal right, and amortization of patents and licenses that are used to generate the intangible asset. So basically, any or anything that was used to prepare or to establish the internally generated intangible asset. Of course, when we discuss this, we need to bear in mind that all research costs, because you can still justify the research cost, was important, or it was actually essential in preparing the asset. But of course, the standard specifically stated that research costs will be expensed. As for the development cost, we can also justify that the development costs are essential to the development of the asset. But of course, the standard also specifically stated that development costs will only be capitalizable after after the entity is able to meet the 6 requirements, letter A to letter F of the standard. So in that case, research and development cost will be expensed, or the only capitalizable cost will be from the establishment of technical feasibility onwards. That will be the capitalizable cost in that case. And of course, we add these particular items A, B, C, and D. Okay? The following are not components of the cost of an internally generated intangible asset, just so we can emphasize. First will be selling, administrative, and other overhead expenditures, unless the expenditure can be directly attributed to preparing the asset for use. So this is again a principle which should be justified, or should be established by the entity, okay, in order for them to completely or to correctly capitalize that particular cost. Okay? But in general, selling and administrative and other overhead are not capitalizable. Letter B, identified inefficiencies and initial operating losses incurred before the asset achieves planned performance. So because these are basically abnormal losses and wastages. Letter C, expenditures on training staff to operate the asset, because these are normal training costs, not relating to the asset, but basically for the use of the asset already. Okay? So once we are able to establish those things, okay, we are able to capitalize already all the costs. We are now able to use the asset. The next question there is, when will we recognize items as an expense? Okay? So it says here, expenditure on an intangible item or an intangible asset shall be recognized as an expense when it is incurred, unless letter A, it forms part of the cost of the intangible asset that meets the recognition criteria. You can look into paragraphs 18 to 67. Of course, I omitted this already because we already emphasized it in this particular text. Okay? So generally, everything that I stated a while ago, from separate acquisition until exchanges, until internally generated, those are the things that we were talking about, which are stated in paragraphs 18 to 67. So basically, it is expense unless it is capitalizable, as provided in paragraphs 18 to 67 of the standard. Or the item is acquired in a business combination and cannot be recognized as an intangible asset. If this is the case, it forms part of the amount recognized as goodwill at the acquisition date. You can refer to IFRS 3. So what are we trying to say here? Basically, if an item is not, or if the item spent is not attributable to any particular specific item, then it is now going to be recognized as goodwill. And of course, it was emphasized even in your lower years that goodwill should only be recognized in a business combination. So there is no such thing as internally generated goodwill. So if you have an internally generated goodwill, it is not recognized in the books, or it is not going to be recognized as an intangible asset, because only goodwill arising from a business combination will be recognized as an intangible asset, but not under IAS 38, rather under IFRS 3. Okay, so I hope that's clear. Okay? Past expenses, not to be recognized as an asset. So specifically stated by the standard, expenditure on an intangible item that was initially recognized as an expense shall not be recognized as part of the cost of an intangible asset at a later date or at a later date. Okay? So with that, we now go to measurement after initial recognition. So of course, we already have an intangible asset. We already capitalized the cost. The next thing there is what are we going to do with the asset while we are using it already. So similar, again, just like what I stated before, intangible assets and property, plant, and equipment are basically the same because they are also using the same measurement methods for subsequent recognition, which are cost model and revaluation model. Okay? But the only difference here is that in the case of intangible assets, we cannot simply use revaluation model without an active market basis or an active market basis. Meaning, for revaluation model, the intangible asset will only be measured under revaluation model if we have an active market for intangible assets. Okay, that is why in the case of the Philippines or for Philippine board examination purposes, we do not encounter or we have not yet encountered any question which is trying to measure an intangible asset using revaluation model. And the reason is because there is no active market for intangible assets in the Philippines. Okay? And please take note that the Intellectual Property Office is not an active market, but rather it is just an office wherein we can register our intangible assets. They do not provide a value or a fair value to our inventions because we do not have an active market in the Philippines. Okay, so maybe in the future, it is possible. Okay? So anyway, let's proceed. So for cost model, it's very easy. You get the cost, and then we're going to have accumulated depreciation, accumulated amortization and accumulated impairment loss. So similar to PPE, cost less accumulated depreciation and accumulated impairment loss. In the case of revaluation model, just like what we said, we get the fair value and then we depreciate the fair value. Okay? But again, to reiterate, okay, the fair value that will be used there, fair value shall be measured by reference to an active market. Okay, so just to specify, we cannot simply use because most of us are already aware of IFRS 13, wherein there is a level 1, level 2, level 3 input. But that's only applicable to other assets which allows any fair value basis. But in this case, specifically provided by IAS 38, fair value shall be measured by reference to an active market, meaning we are only going to use fair value which is a level 1 input. If it is not a level 1 input, then we cannot use revaluation model. Okay? And since we cannot use revaluation model, then we are going to, by default, use cost model, of course. Okay? So the revaluation model does not allow the revaluation of an intangible asset that does not previously or that have not been previously recognized as an asset. But of course, that's very self-explanatory because if it is not an intangible asset, then revaluation model cannot be used. Or the initial recognition of intangible assets at amounts other than cost. Okay? So, revaluation is not allowed or it does not allow the initial recognition of intangible asset at amounts other than cost. So, meaning, under the revaluation model, we still should start with cost. Then afterwards, we can use revaluation model if in case there is a fair value or there is an active market. Okay? If an intangible asset in a class of revalued intangible assets cannot be revalued because there is no active market, okay? Similar to your IAS 41. So even if you would like to use fair value model, since there is no fair value, we're going to use cost model. So in this case, it's the same. Even if all other intangible assets have a fair value under an active market, but an item of intangible asset does not have an active market and therefore does not have a fair value, then we are going to account for it using the cost model, which is cost less accumulated amortization and impairment loss. Okay? Let's proceed. If the fair value of a revalued intangible asset can no longer be measured by reference to an active market, the carrying amount of the asset shall be its revalued amount at the date of the last revaluation by reference to the active market, less any subsequent accumulated amortization and any subsequent accumulated impairment losses. So what are we trying to say here? It simply means that upon the last time or at the last time that we have reference to a fair value under an active market, that will be effectively the cost that will be subjected to amortization and impairment in the succeeding periods. So in other words, we are now going to we're simply just going to depreciate it. We're just simply going to amortize it the usual way without any remeasurement anymore of fair value because fair value is not present any longer. Okay? If an intangible assets carrying amount is increased as a result of revaluation, similar to property, plant, and equipment, what are we going to do? We reflect the excess as revaluation surplus, which is presented in other comprehensive income. Okay? However, the increase shall be recognized in profit or loss to the extent that it reverses a revaluation decrease of the same asset previously recognized in profit or loss. So meaning, if there was a previous impairment loss before we recognize any revaluation surplus, we first reverse the impairment loss, similar to what we learned in IAS 36. If there is a decrease as a result of revaluation, meaning there is a reduction in the value under revaluation model, then we are going to recognize that in profit or loss. But again, similar to what we learned in under the revaluation model, before we recognize any amount in profit or loss as a loss on fair value change, we need to see first or determine whether there is still a balance in revaluation surplus. Because the said balance will first absorb the revaluation decrease, and then any amount that is not absorbed will now be recognized as impairment loss in our profit or loss. So that's basically how it works. Now, let us proceed with useful life. So, useful life is very important because this is what determines or what delineates an intangible asset with definite useful life and intangible asset with indefinite useful life. So, of course, we know that an entity needs to be able to assess whether the useful life of an intangible asset is finite or indefinite. Okay? So if finite, of course, at least we already know the number of years or the productive capacity of a particular intangible asset, then we are going to amortize it. Okay? But if the life or the useful life of an intangible asset is indefinite, take note, indefinite and infinite are two different terms. Indefinite simply means that we do not know how long an asset can be useful. That's why we cannot amortize the item. It does not mean that it is going to be useful infinitely. Okay? That's two different concepts. Okay? So anyway, in the case of indefinite or assets with indefinite useful life, since there is no theoretical limit, we do not know how much or how long we can use the asset for the foreseeable future, then we're going to subject it to impairment or tested for impairment at least annually. Okay? So what are the factors that we usually consider in determining the useful life of an intangible asset? So of course, we have the expected usage. Okay? Based on the assessment of a management team. Second will be the typical product life cycle of the asset that is going to be generated using that particular intangible asset. Letter C, technical, technological, commercial, and other types of obsolescence. Of course, this is going to be based on the degree of competition and the degree of the technological developments within the industry. We have the stability of the industry in which the asset operates and changes in the market demand for the product. Okay? So, of course, similar to the product life cycle, the demand can also be a basis of the useful life of the intangible asset. Letter E, we have expected actions by competitors or potential competitors. So, meaning if, let's say, for example, even if you think that you can use the asset for 10 years, if you expect that your competitor will or will be able to develop a more competitive patent or more competitive intangible asset by or in 5 years, then the useful life of your intangible asset is only 5 years and not 10 years. Okay? Letter F, the level of maintenance expenditure required to obtain the expected future economic benefits. Because in this case, if the cost is already too much as compared to the economic benefits, then it is not practical to continue using the intangible asset already. So we will only consider the asset as useful until the time or up to the time that the cost of maintenance is still lower than the economic benefits that the company generates. Letter G is the period of control over the asset and legal or similar limit. So usually this is what we call legal life or the number of years that is being allowed by law for us to take control of the asset. And then letter H, whether the useful life of the asset is dependent on the useful life of other assets of the entity. So meaning there is no independent useful life, but rather its usefulness depends on another. So it is simply an attached item. That is why there are problems that we encounter wherein an entity will purchase another patent, but the patent is only purchased to protect the existing patent. So in this case, the newly purchased patent will not be amortized independently, but rather it is going to amortize in the same way or in the same pattern as the amortization of the patent that is being protected. Okay, so meaning there is no independent or separate amortization for this particular intangible asset. Okay? So the useful life of an intangible asset that arises from contractual or other legal right shall not exceed the period of the contractual or legal right, of course. Okay? If the contractual or legal rights are conveyed for a limited term, that can be renewed. Okay, so meaning it is for a fixed term, but it is renewable, then we need to consider whether we are going to add up or we are going to consider the renewal portion. Okay? So, the useful life of a reacquired right recognized as an intangible asset in a business combination is the remaining contractual period of the contract in which the right was granted and shall not include renewal periods. Okay? The reason here is because since we're talking about renewal periods, renewal is only talking about the initial parties in a contract. So meaning if it was acquired in a business combination, we are not generally going to consider the renewal period because in a business combination, the original party to this contract is generally dissolved already. So meaning there is no capability for the original party to have the transaction renewed or have the contract renewed. So in this case, the renewal period will not be included. But as a general rule, the renewal period will be considered. Okay? So, the existence of the following factors, among others, indicates that the entity would be able to renew the contract or legal rights without significant cost. So, what are items that you need to check? So, first is there is evidence, okay, possibly based on experience, that the contractual or other legal rights will be renewed. If renewal is contingent upon the consent of a third party, this includes evidence that the third party will give its consent. Okay? Meaning, there is evidence that there is really going to be renewal based on past experiences. Letter B, there is evidence that any conditions necessary to obtain renewal will be satisfied. And the cost to the entity of renewal is not significant when compared with the future economic benefits expected to flow to the entity from the renewal. So take note that is "and" So meaning, in analyzing whether the renewal option or the renewal portion will be exercised and thus will be considered in the amortization of the intangible asset that we acquired, we need to consider all of the items from letter A, letter B, and letter C. Okay? So with that, since we are talking about intangible assets, amortizations, and useful life or um, impairment losses, we need to focus on the two basic types of intangible assets, which are intangible assets with finite useful lives and intangible assets with indefinite useful lives. So let us first start with intangible assets with finite, okay? Or with limited useful life. Okay? So basic concept for amortization period and amortization method. So the depreciable amount of an intangible asset with a finite useful life shall be allocated on a systematic basis over its useful life. Amortization shall begin when the asset is available for use, meaning when it is in the location and condition necessary for it to be capable of operating in the manner intended by management. So regardless of whether they are using it already or as long as it is already capable of being or capable of um what you call this capable of being used already, then we can actually start amortization already. Okay? Next, amortization shall cease at the earlier of the date that the asset is classified as held for sale or in the period it is recognized. Okay? For the amortization, okay, the general rule is that we're going to amortize the intangible asset based on the expected pattern of usage. Okay? If there is no pattern, okay, if there is no pattern that is established, then we're going to use straight line. Okay? So, whenever we amortize an item, the first thing that we need to do is to, number one, look for the pattern. Okay? Pattern of usage. Okay? Or based on the pattern of expected benefits. Okay? If it is not, or there is no pattern that was established, then what we're going to do is we're going to then use the straight line method of amortization. Okay? And since we're talking about amortization, we need to determine whether residual value should be considered. Okay? According to the standard, as a general rule, intangible assets should have zero residual value unless we are able to establish a residual value that is based on a third-party commitment, okay, or an active market, okay, that is based on IFRS 13, okay, wherein the residual value can be determined by reference to that active market, and it is probable that such market will exist at the end of the useful life of the asset. Okay? So, what are we trying to say here? If there is a problem that we encountered, okay, and there is no residual value provided, then of course, residual value is automatically zero. Okay? If the residual value is provided, we need to assess and determine whether the residual value is in reference to either A or B. If it is either committed by whether it is a third party commitment or it is based on an active market. Since this is or for as long as A or B exists, then we can use the residual value provided. But if neither A nor B is provided to us, then always assume that residual value will be zero. Okay, so that's how it is. And since we're talking about amortization, we need also to review at least at each financial year end. So meaning at least annually, we need to review the amortization period and method. Okay, so that's for items with finite useful lives or intangible assets with finite useful lives. Okay? How about for intangible assets with indefinite useful lives? Of course, since there is no useful life or there is no specific useful life, then we cannot do the unusual amortization. So instead, in accordance with IAS 36, which we already discussed before, no, it simply requires us to test for impairment the intangible asset at least annually, or whenever there is an indication that the intangible asset may be impaired. So at a minimum, it should be done annually. Okay? But in addition to the annual requirement, every time there is an indication of impairment, even if we already made an initial assessment, we still need to compute for the amortization every time there is an indication of impairment. Okay? So, how about the review of useful life? Okay? Because we are talking about items with indefinite useful life, the standard also requires that we need to assess whether the indefinite life is still applicable to the intangible asset. Okay? And it will be reviewed each period, meaning every year at a minimum. Okay? And to determine whether there is evidence that will support that there is still indefinite life. In the case that they found evidence that indefinite life is no longer applicable, meaning we already know when or until when we can have economic benefit for the intangible asset, then we're going to change from indefinite to finite useful life. And what are we going to do? We will account for the change as a change in accounting estimate in accordance with IAS 8. So meaning it is the same as change in depreciation method for PPE. So this time we're going to change, or we're going to recognize amortization already. Okay? So that's for intangible assets with indefinite useful lives. Okay? For recoverability of the carrying amount, okay, just like what we discussed when we were discussing IAS 36, we stated that regardless of the type of asset, okay, for as long as it is covered by IAS 36, in this case, intangible asset is covered by IAS 36, the same assessment for impairment losses will be done, which is basically the assessment of the carrying amount as compared to the recoverable amount. Recoverable amount being the higher of the fair value less cost to sell and the entity specific value or the value in use. Okay? Retirements and disposals. This is the second to the last topic. So an intangible asset shall be recognized in your FS or in your financial statements at the time of disposal, or even though it is still in your possession, as in your possession in or your the title is still with you, but if there are no longer economic benefits to be expected, then you need to recognize it already. In other words, the value is already zero. Even if you still have the title to it, but it has no longer, or it has no value anymore, then it will already be recognized. Okay? So the gain or loss arising from the recognition of an intangible asset, if any, shall be determined as a difference between the net disposal proceeds and the carrying amount of the asset. So similar to how we compute for the normal gains and losses. Okay? And then it shall be recognized in profit or loss. Okay? Unless IFRS 16 requires otherwise in a sale and leaseback, or unless gains shall not unless another standard requires us to have another accounting treatment. Okay? And of course, gains shall not be classified as revenue. Just to emphasize that gains on the sale of intangible assets are not considered as revenue coming from the ordinary course of business. Okay? So with that, we go to the last topic, which is disclosure. So we have general disclosures and other specific disclosures. So if you try to evaluate, the general disclosures for intangible assets are actually the same. Are actually the same as the general disclosures for property, plant, and equipment. So if you look at it, basically, the entity shall disclose the following for each class of intangible assets, distinguishing between internally generated intangible assets and other intangible assets. Okay? So if the useful life are indefinite or finite, okay, and if finite, the useful lives or the amortization rates used. So similar to the depreciation rates and the depreciation based on useful life. Amortization method, gross carrying amount, Okay? Line items and reconciliation of the carrying amounts from beginning and the end, showing the details and computations. Okay, so those are the same as the general disclosures for PPE. Also, the entity shall disclose the following: for an intangible asset assessed as having an indefinite useful life, the carrying amount of that asset and the reason supporting the assessment as having indefinite useful life. Meaning you cannot simply claim that it has indefinite useful life. You need to have, or you need to show proof that indefinite life really exists. Letter B, a description and carrying amount and remaining amortization period of any individual intangible asset that is material to the entity's financial statements. So meaning, these are intangible assets that are directly related to the continuing or the capacity of the entity to continue as a going concern. Meaning, if these intangible assets suddenly got impaired or suddenly got removed from the entity, then it's going to have an effect or a major effect to our financial statements. Letter C, for intangible assets acquired by way of government grant and initially recognized at fair value, we need to make disclosures for the fair value initially recognized for these assets, the carrying amount, and whether they are measured after recognition under the cost model or revaluation model. So this is specific for government grants. Also, we also need to disclose, aside from letter C, A, B, and C, we have the existence and carrying amounts of intangible assets whose title is restricted and the carrying amount of intangible assets pledged as security for liability. So these are for encumbrances and other third-party controls or restrictions. Letter E, the amount of contractual commitments for the acquisition of intangible assets, if any. If you plan to, or if the entity plans to purchase additional intangible assets. Okay? So, intangible assets measured after recognition using the revaluation model. So, if we're going to use the revaluation model, then we need to disclose the following. Okay? So, disclose by class of intangible assets. So, by different classes, the effective date of the revaluation, the carrying amount, okay, of the revalued intangible asset, the carrying amount that would have been recognized had the revalued class were measured at cost. Okay? So you already used revaluation model, but still you need to disclose the value if you use the cost model. Okay? And the amount of the revaluation surplus that relates to the intangible assets together with um, computations, because it is talking about the beginning and the end of the period, indicating the changes during the period, and any restrictions on the distribution of the balance to shareholders. Okay? Because, of course, since these are presented in, or the revaluation surplus is presented in other comprehensive income, we need to disclose whether, if this reverses, if it is going to automatically be part of retained earnings, which can be distributed as dividends or not. Okay? In the case of research and development expenditure, you need to disclose the aggregate amount of research and development expenditure recognized as expense during the period. So meaning, aside from the expense being recognized in your statement of comprehensive income, you also need to provide the details of these particular expenditures. Okay, other information, the entity is also encouraged but not required to disclose the following information. First, a description of any fully amortized intangible asset that is still in use. Okay? So this is generally going to talk about intangible assets that are internally, or that are for internal use only. Okay? And letter B, a brief description of significant intangible assets controlled by the entity but not recognized as asset because they did not meet the recognition criteria in this standard, or because they were acquired or generated before the version of IAS 38 issued in 1998 was effective. So this is actually very long already. So for entities that have been that are long existing prior to the IAS 38's current version, particularly the initial effectiveness, which is 1998. So you need to make disclosures. So for most companies who have been existing or who has intangible assets before that no longer are considered as intangible assets because of the new provision of IAS 38, they need to make additional disclosures for such. Okay? So with that, that is the end of our presentation.